Alright, let's talk about the concept of a master budget. A master budget consists of three components. The first is the operating budget. This is the type of budget that most people are familiar with. It's like the income statement of the company. It forecasts revenues and operating expenses, etc., but to have a complete budgeting process, that's not enough. There's also a capital expenditures budget. This is more like a balance sheet type of budget. This actually takes into account capital spending on things like non-current assets, property, plant, equipment, etc. And then finally, there's a cash budget. The cash budget sort of connects the other two and completes the three set of financial statements. This actually details when the cash will be flowing in and out of the business and ensuring that there's enough cash available to meet the needs of the company. So when we take the three together, we're then able to have a budgeted income statement, balance sheet, and cash flow statement for the company. This will represent a very robust budgeting process. Not all companies do this. There are smaller companies that really just focus on the operating budget. But if you want to have a very robust process, it is important to have all three of these in place, and that's what we're going to cover in these next few sections. Let's take a closer look at the three types of budgets we outlined in the previous section on the master budget. The first is the operating budget. This is the one we're all most familiar with. This is where revenues and associated expenses are built out in detail, typically broken down into categories such as salaries, benefits, operating costs, cost of sales or cost of goods sold, etc., and even include a detailed headcount, perhaps on a person-by-person level. This is where most departments will focus the majority of their time in building their budget. Next comes the capital budget. This is where typically, in the form of a request, large amounts of capital are asked for. And these include things like buying new equipment, new property, or investing in IT systems, or something that will have a benefit that lasts more than a year. And this requires careful allocation of capital, risk management, and all sorts of executive decision-making. So the budgeting process for capital budget is a little bit different. It's much more of a request than it is of the day-to-day operation like the operating budget is. And then finally, you have the cash budget. This ties the other two together and takes into account the timing of payments and the timing of receivement of cash from revenue. So it actually estimates on a monthly basis typically, although it could be more frequent than that, even weekly in some cases. The timing of the cash flows, for example, when will the revenue actually be received? For some companies, it might come in very quickly, if it's a direct consumer type of company. But if it's a long lean time business-to-business business, then you have to factor in that it might be months until revenue is received in as cash. So all this is incorporated, as well as timing the cash flow expenditures. When are we actually going to pay the bills, etc.? And then in combination of the cash inflows and cash outflows, it's easy to monitor the cash balance of the company in the future. And then the decision can be made about whether or not additional capital is required, whether the business has to raise money, or whether it has excess capital, and all sorts of strategic decisions can be made as a result of that. So it's important to have the three of these as distinct budgets. Just to recap, the majority of time and focus from departments will be on the operating budget. A select few leaders in the organization will focus on the capital budget and major projects that require capital. And then finally, the cash budget will tie the other two together and help the business manage its cash flow effectively.